of September, and we are live here on YouTube, on LinkedIn, on Twitter, and Facebook, and in person. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. I'm joined once again with my good friend, Doug Hagren. Hey, Doug.
Happy Friday, Kirk.
Happy Friday. Every Friday is a happy Friday, Doug.
Especially when you can kick your feet up at the end of the day with a cold one.
That's true. That's true. Or just kick your feet up and not have to
Just
go back
kick
to
your
work.
feet up with whatever, right?
Yeah,
And
whatever.
even to close your eyes and take a power nap, especially at this age. At my age, and now I get it. I didn't get it as a kid, but I covet every moment that I can take. I can just sit back and decompress and close my eyes for a few. So
I concur, Doug. I know as a kid, I was like, why do these people want to sleep? I just want to get up and run around. And now I'm just like, if I could rest for just 5 minutes and close my eyes, that would be enough. But I can't, Doug, because there's an enormous hurricane coming up to the Northeast. And every single person I've talked to is like, oh, you're prepared for the hurricane. Now, nothing against them, because most of them are conditioned to think that by watching the news and the media and all this other crap going on. Is there a hurricane? I don't know. All I did is I looked at my weather app, and it said there's a 50% chance of rain in my area in the next 2 days. Oh, it went up to 60%, and it's not Saturday when the hurricane is, it's actually Monday. So apparently there's no rain when the hurricane is coming. So it's just going to be high winds, which means I don't know what I do. Do I stay inside? Do I tape up my windows? Should I go to the grocery stores and clean out all the water and milk? Of course, you got to have as much milk as possible because milk stays for long periods of time. And like, should I clean out all the grocery stores? What should I do? Well, hold on, let me turn on the news so they can tell me what to do. Oh, you want me to lose my mind and freak out and start beating people up in the streets? All right, I'll go do that. Like, I mean, it's like the craziness that goes on with a little bit of fear. Now, I bring this up because this actually does have a point. I'm not just going crazy here. This has a point. So when you think about any instance where people are afraid, and a hurricane, most people aren't afraid, but the news will make you afraid. They do a damn good job at that. That's their primary role, is to push that fear button in your mind to get you freaked out. So then your next question is, what do I do? Well, hey, great. It's a good thing we're here to tell you what to do. You need to vote for this person. Oh, I'm sorry. We're not supposed to say that. The reality is the media has a point, and it's no longer news anymore. It's propaganda, or it's paid for advertising for the most part, which is why I don't watch it. And you could say, well, my people are correct. I don't really care. I don't watch it. I look at all of it and I'd say all of it's junk. But if you look at how they're doing it, and this is the lesson, right? Is what the media does is they push that fear button in your mind. When they push that fear button, you immediately freeze. I think about 70% of the people freeze, and they say, what do I do? They need to be told what to do. And this is a statistical fact. This isn't me blowing smoke. About 70% of the people will freeze in any situation. If you're on a boat and it capsizes, and I don't mean freeze, this isn't a joke, so excuse the pun, and you get in the water, 70% of the people will freeze. They won't know what to do. They'll just sit there and they'll wait for someone to tell them what to do. 15% are going to freak out. They're going to grab onto anyone around. They're going to take people down. If anyone's a lifeguard, you know exactly what I'm talking about. They tell you to stay away from those people. And actually, if you're saving those people, some people will punch them in the face and knock them out so they can actually save them. They're so crazy because they lose their mind around the situation because their brain doesn't know how to react. So they do exactly the opposite of the right thing is how it's construed. And then there's 15% of the people who do exactly what they're supposed to do statistically, right? And you might say, well, I'm in this group. I have no idea. Like, if I'm not in a plane crash, I don't know how I'm going to act. So no one really knows until you're in it. The point is to understand that this is how our brains work. When you have fear, naturally you gravitate towards, what's the answer? Tell me what to do. Okay. Now, this is in media. We're talking about media. It also happens in finance. It happens every single day. Oh my God, the world's going to end. What do I do? Oh, I have the answer. Buy gold, buy Bitcoin. You need to invest in the S&P 500. You need to put your money in an annuity. You need to put your money under the mattress. Whatever it is, everyone's got an answer for you. And because magically they're selling that, they're giving you fear, and then they're also giving you a solution. This is how psychology and selling works. So if somebody is up there and they're saying, hey, you need to do this because the world's going to end, Just wait. Just wait about 5 minutes until they say, "Oh, by the way, I have the answer for you." It's gonna come. Like that's why we don't scare the crap out of people on this podcast. A, because I think it's totally unethical. B, because I don't need to, because I'm not selling anything. And C, because we're trying to teach you something. I'm not going to teach you anything if you're freaked out, right? If you're here listening and you get my lesson, it's because I didn't freak you out, right? And you might be freaked out now that the news is propaganda. And if you are, this is probably the first time you listen to the show because we talk about this all the time. But everything you hear now has a point. There's very few unbiased sources of information nowadays. You know, government data, media, politics, whatever. Like it all has a bias, and so our job nowadays is to help sift through that. Now, I'm going to give you a framework, and then we're going to go to Doug, and we're going to start into the actual like news here. So there's a something I saw. I forget where it was, but I want to bring it up here and share it on the screen because I thought it was a great visual. But I'm going to explain it. You don't have to see this. You can just kind of watch it. So here it is. So think about the things you can control, and that automatically eliminates about 99% of your thoughts because there's very little we can control in life. That's Darius Farouk's, I guess is the name. Maybe I mispronounced it. Anyway, the point is there's a visual here, and I want to point this out because in life we try to control everything, and when we feel like we have control over it, we feel safe and secure. If we feel like we don't have control over it, it brings a lot of fear, right? Let's give you an example, like death. We have no control over death, right? We have no control over what happens after death. We have no idea what happens after death. Everyone has a theory, but the fact that you feel like you have some control, right? Somebody tells you this happens after death, or here's a way to extend your life. You feel better because there's something you don't control, and now you're getting somebody saying, here's a control system that you can use to feel better, right? So here are the things that, as investors, here are the things we want to control. We want to control risk. We want to control cost. We want to control time. We want to control behavior, and we want to control returns. So there's more, but those 5 things are things we want to control. So what do we actually control out of those 5 things? Well, we can control the risk. We can control the cost. We can control time. We can control our behavior. What's the one thing we can't control? Return. We cannot control performance, but that is the one thing everybody focuses on. Everyone wants to focus on returns, performance, performance, performance. They don't focus on any of the other things. If they do, they get a minor side note. Everyone wants to focus on performance. That's the one thing we can't control as investors, as people. It's like saying, I can control the future. If we could control it, everyone would be a bazillionaire, which means that your money wouldn't be worth anything. But the problem is everyone wants to control the future and performance, and they don't. So we only focus on that, but you've got these 4 other things that actually affect the return. The return is a result of these other 4 things, but we almost never focus on those other 4 things. Risk. Well, I am focused on risk because I'm diversified. Diversification isn't risk management. That's volatility management. Look at last year, did you lose 20 to 30%? How'd that work out for you? How was that 60-40 portfolio? Diversification didn't work last year because it doesn't work in times of distress. The markets are different than they were 30 years ago. But we can control risk. There are ways to control risk. Okay. Cost. We can control costs, right? You can pay a hedge fund 2 and 20, or you can buy, a Vanguard S&P 500 fund for 5 basis points, or what do they charge now? 2 or 3 basis points, right? You can control your cost, right? You can decide which is more important. I'm not making a distinction, just saying you can control your cost. You can decide what you want to pay. Time, okay. Time is a big factor. Do you control the amount of time you put in? Do you control how much time you invest in something? Time is a variable that you have control over. You can buy for 5 minutes, you can buy for 5 years or 50 years. It's up to you, right? You can control the time. And behavior, you can control your behavior. You can control how you react. Do you freak out? Do you wait? Do you, you can map out your behavior ahead of time. I'm buying this stock, ABC stock. what happens if it goes up? What happens if it goes down? And you could write it out. Say if it hits this marker, I sell. If it hits this market, I buy more. Whatever your plan is, write it out. You can decide your behavior. Some people entomb that into a computer, and the computer does the trading for you. That way you don't have to make that decision. You can control those four things. The one thing you can't control is return, but that's the only thing everyone ever focuses on. So keep that in mind, that in life and in investing, it's the same thing. Do you worry about getting hit with a meteoroid? Do you worry about crossing the street? Do you worry about all of these things in your life? How many of them can you actually control? Well, you cannot leave your house. That won't save you from the meteor, but you can not cross the street the rest of your life. So some things you can control, some things you can't control. But just understand in life that you should worry about the things you can control, because the things you can't control, you can't control. So why worry about them, right? At some point, you're going to die. That's unfortunate. Can you control when? Well, somewhat, but for the most part, you can't. So why worry about it? Because there's nothing you can do, right? All you do is make the most of your situation today. That's all you can do, is just make the most of what you have now. And I think if you look at any sort of mental model, everything falls in the same model. So just understand the control points, and that will help you be a better investor and make better decisions in life as well. Doug, what are some of your thoughts?
Well, I want to go back to what you said earlier, which is completely different than what you were just talking about. But let's talk about the news
Good
again.
segue.
Yeah, and the influence that you were mentioning. So I just happened to look here, and according to this, the hurricane is traveling due north, and it's going to hit New Brunswick, which isn't even anywhere near you. And as of right now, you have about a 10-15% chance of, I don't know, up to 35-mile-an-hour winds brushing Boston. So the reason I'm bringing this up is this was taken by the news and spun as hurricanes are going to hit you. Also, by the way, just a little known fact that most people don't know that when they say 50% chance of rain, it does not mean that there is a 50%, like 50-50, like 1 out of 2 chance that a rain's going to hit you. It means 50% of the geographical area will have rain. It's weird. It's a completely different than most people understand about that. So
I learned something new today.
Yep. So yeah, I learned that, and I was like, it was mind blown. I was this age when I figured that out. But so it's really cool. So that means you could be, if you're in that area, half the area will have rain and the other half will not. That's what that means. So, but basically, why am I coming back to that? Because it is the news. You mentioned that, of course, the news creates this panic. This panic drives a narrative. We've mentioned this narrative before. This narrative is to sell advertising. Because what's the first thing that people do when they start to get an emotional response from what they're reading or what they're viewing? They keep reading and they keep viewing. And it's all about how long your eyes are going to stay on that subject. So they're not there to give you information that is necessarily going to be helpful. Listen, the best information is going to be something, say, here's the facts on a plate, go run with it. They don't want you to run with it. They want you to see the facts that are on the plate and then rely on them to continue feeding you information that will eventually give you an answer that never comes. That's why they call them news cycles. And by the way, what does a cycle do? It goes round and round and round. And it's to keep that emotional response constantly going. Now, like you were talking about, Kirk, let's get back to what you're just saying. There are the things that you can control, things you can influence, and the things you can't control, right? And so you cannot control the markets, but yet we, again, going back to the emotional beings that we are inherently driven by the need to have more, and we compare ourselves. And this is an innately human response. A squirrel is programmed to gather as many nuts as they can and put those nuts in a shelter that will allow them to consolidate their heat and hibernate, or mildly hibernate, but basically live out the winter. That no time does that squirrel ever look at the other tree, because he might have built a leaf nest. We've seen squirrels live in those big leafy nests up in trees. If you live in the deciduous part of the country, you'll see that. You know what I'm talking about, where we live. All the leaves are gone on the trees. But there's this big ball of leaves. That's a squirrel nest. Sometimes they live in a hole in the ground. Sometimes they live in a hole in a tree. What a squirrel never does is look over at that other squirrel and go, dang, he's got more than me. He's got more acorns. He's got a bigger home. Gosh, he's got a nicer home. And look at the squirrel car parked out front. He's got a nicer squirrel car. This is inherently a human response. We are programmed to be envious and jealous of the people around us, and it's only driven in our own minds. That leads, as a human response, the need to be able to covet more and lose less under every single turn. And it is a fear-based driven world. Even if you are achievement-based, this is a fear-based driven world. The fear of not having more, even if that is to be the most you could ever have, right? And just because of ego, there's that fear that right now that Bezos is going to be worth less than Musk. And that fear that, and even down to the bottom of not having enough food on your plate. So the drive of fear leads us to focus on. And here's the thing. If you are worried about your performance, you're worried about your performance for bigger reasons than just what that performance is in fear and ego. It's a fear of not having enough security, not having enough. And the way that people tend to focus on overcoming that is to try to enhance greed and earn more. So just again, not to go down this road, I think it's really important to understand that there's only so much that the markets are going to be able to do for you. Okay. They are there to grow what you have and keep up with some level of inflation so that you will have more in the future. In order to do that, though, comes back to the discipline that most of us don't have, like saving diligently, like spending less, like having areas of safety, protected income, like Social Security or pensions, if they still exist, that allow you to have it. It all comes down to cash flow. And as Americans, we are woefully under where we need to be in terms of what we should be saving in order to be able to continue at a lifestyle that we're accustomed to. And it doesn't matter if you're used to making $50,000 a year or you're used to making 500 or $1 million. Some of the people that have 500 or $1 million that have the most saved are still worse saved for what their lifestyle is. And how do those people react? And you might be one of them listening to the fact that you have not done the discipline you need. It's through greed. It's through thinking my portfolio is not making enough. The squirrel there has more acorns. Focus on what you can control and then focus on fixing the areas of risk, and then everything will work out. But unfortunately, and we can look at lots of charts that we have in the past and we'll continue to look at today, most people are not doing the things they can control. And unfortunately, that forces you to rely on the things you can't.
Yeah, that's really important. So let's get through a few charts here. I'm gonna light up a few charts. Just want to say, in the spirit of things, I'm just smoking a big doobie here. I want to show this chart, and sorry, it's not actual doobie, but it's the best I could do on short notice. So this is a chart of the biggest cash crops in the U.S. So as of now, marijuana is the 6th biggest cash crop in the U.S. Corn being the biggest, soy being second, then hay, then wheat, then cotton, and then marijuana.
Dude, that's so cool.
Dude. So, I had to poke a little fun because there was some news out 2 weeks ago. I don't remember what it was, but it had something to do with, there was some positive direction in the marijuana direction. For those of you who don't approve of marijuana, I don't have an opinion, so just you can yell at somebody else. But I bring it up because it's a trend, and I think the trend is definitely going in the direction of legalizing marijuana. In the big key is obviously the federal banking around that. So when the feds allow banks to do business with marijuana related businesses, that will open it up for everything. Because right now it's cash business, so it creates other problems, right? It's a cash business, which means you're all in cash, which means people are going to steal, which means you're still kind of an underground economy, even though technically it's legal in states. It's also kind of weird. So anyway, I just pointed out because I thought it was interesting. It's gotten so large, and look, I mean, if it works for you, it works for you. I don't do that sort of thing, but I don't judge either. So I want to
Kirk, can I add something really interesting on that I learned this weekend?
Yeah.
Because you're talking about the biggest problem with the banking is that marijuana is still federally illegal, and obviously it's only been legalized at the state level. Well, because it's federally illegal, anything that is a federal regulation has a problem still with marijuana. So again, not to, I know there's people out here that are gun advocates and I know there's people that are anti-gun. So I don't know who you are and I apologize, but I'll just say that I was hearing a story from someone who was at a club, for a gun club. And one of the things that they were warned is that the ATF just came in and said, just a reminder to everybody here, if anybody shows up having had any marijuana, it is a federally illegal offense to be able to use this gun here because marijuana is still legal and this is a federal act. So it is the stickiest, craziest thing, and that we've got between states that have legalized in the federal level. Anyway, just a segue there, but there is a lot of things that people don't know, that even though they might be allowing you to use it in your state, be very, very careful if you are someone that partakes in where you're using it and how you're using it, because you could be violating federal law that could end up being backfiring.
Yeah, I mean, it seems like a weird time frame that we have a bunch of amendments being challenged. We've got case law being challenged. We had Roe v. Wade. We've got the First Amendment, which is under fire all over the place. Which I guess was a recent case that passed the appellate court for the Biden versus Missouri, which is basically a First Amendment case. And it's probably going to go to the Supreme Court, would be my guess, just because they're not going to want to let that stand. So they're going to appeal it. So we'll see. But you have things like that. Like I said, this isn't here to judge rightly or wrongly, which side's right or wrong. I don't, it's not my place to say. Everyone's got their opinion, and your opinions are yours, mine are mine. So, but I will say one thing you never hear me do on this podcast is apologize. So, Doug, that's the first. That's the first. Thank you for bringing the apology to our podcast, because that's not something I do.
I'll never do it again, Kirk. I promise.
Okay. Just making sure. You can apologize. Just apologize for me, because I'm going to apologize. Anyway, let's get to real stuff. So,
apologize for you or apologize to you. We'll work that out later.
Either one. Either one's fine. Anyway, so this is a chart that I saw and I thought it was interesting, and it was a chart of the SPAC market. So this is this is SPACs. If you don't know what a SPAC is, it's basically a special purpose acquisition, something or other. I forget what the C is, but anyway, the point is what people use to bring their companies public, and it was kind of a way around the IPO kind of stuff. So what happened in 2020 till about 2022? You had a ton of companies becoming SPACs, going public, and it was an end run around the rules, and they allowed it, but now they're cracking down. So you can see the SPAC market started at about 25 billion, and now it's back to 25 billion after going up to about 200 billion. So just wanted to point that out because I thought it was a fascinating chart. It was a trend. You ride the trend till the end, and then you get off, and it's done.
So Kirk, I wanted to say something really interesting on that chart. So just for, again, SPACs. So SPACs are basically special purpose acquisition companies created to raise money through an initial public offering just to buy other companies. They don't have any business operations, stated targets for acquisition, etc. They're structured as trusts. The only thing I wanted to say on that, interesting, they blew up after 2020. What got injected into the system after 2020 that made it really easy to just go out and buy anything, including digital, prints and advertising and pretty much everything out there? Stimulus. There's been a little bit of M2 money injected into the capital, into the system. Yeah, just a bit.
Yeah, there's a big correlation. I think next week we're going to talk about inflation from a historical perspective. I found this great site and totally forgot about it, and they've got tons of great charts, so I'm going to show that next week. And a lot of it has to do with back to 1971, which is a great year to look at if you want to see kind of like what's going to happen in the next 10 years. I've been talking about it a lot, but this actually has graphical representation, so you guys are going to love it. So if you join us next week, make sure you're live on LinkedIn, YouTube, anywhere on the platforms, or you go see the video on YouTube when it comes up. It's going to have all the charts. You're going to love it. It's going to be a very visual episode. If you're not visual, if you're listening to it, it's okay. We'll explain everything, but just letting you know. So here's what we're going to show right now. So this is a chart I saw that I thought was brilliant, and it shows home sale prices, new versus existing homes. Now, what this is measuring is new home builds. So if you just built a house, it's brand new, right? Versus a home that's just resold on the market, right? So it's just like, oh, I'm selling my house. That's existing versus new, which is a new build. So if you notice, the sale of new home prices is always above old home prices. Naturally so. Do you want to buy someone's old, dilapidated home, or do you want something brand new where you know it's good for 20 years? Well, when I bought my condo, it was brand new. It was good for 20 years. I lived there 16. Stuff starts breaking, I'm out of there, right? And so I got a good stint. If I wanted to move to another condo, I'd buy another one, another building, and when it's brand new, I got no problems for 20 years, and then move and do something else. So new home prices are always more. They should always be more expensive. Should being the key word. But if you look at this, what you'll notice is in 2005, new home prices went below old home prices, just a nick below. Almost never happens. So in the last 25 years, somewhere thereabouts, it's almost never happens, but it happened then. And oh my God, it looks like it's close to happening now, Doug. It just missed it last month, and you never know. It could drop. But the point we're trying to make here is this: is the fact that new home prices are potentially going below old home prices means one very specific thing. If you build a house, you have to sell that house. No one's living there. You got to sell it to somebody. You got a profit margin in there. It's better to sell it for less of a profit margin than no profit margin at all. So what you'll notice is new home prices are actually hitting the market and selling. Old home prices are not declining so much. And why do you think that is? Well, let me tell you. Because if I'm selling my home and now all of a sudden I have a 2.5% 30-year mortgage in my home, let's say it's $1 million home, and I want to downsize to a $500,000 home. Well, I downsize, now I got an 8% mortgage. Oh, and my payments are the same. I get the same monthly payments that I had before. And yet I'm in a smaller house. So why don't I just stay where I am? And so a lot of people, like before rates went up, I saw in my neighborhood where there's some expensive homes, like everyone put there are tons of for sale signs on the market. And then immediately, like within like few months, and not immediately, obviously, within a few months, the signs came down and the houses weren't sold. Well, it's because they know that no one was interested. No one was buying. And that's what we're seeing is there are nobody who can buy. And I say nobody, that's a little extreme, but many people can't afford a house nowadays. They can't afford the same house they could have afforded a year ago. And the problem is they're looking to buy in a certain range. They want a 3-bedroom, 2-bath, whatever it is. They don't want a 1-bedroom because they've got kids. And they don't want a 5-bedroom because they can't afford that. So they still want their 3-bedroom, but the problem is the 3-bedroom's twice as expensive. So you can't move. So what do? Well, the people who are selling, they can't sell. So what do? Well, they take it off the market, which means that if houses aren't selling, if old existing home prices aren't selling, it means the price isn't moving. It doesn't mean that they deserve to be at that price. It's like saying, hey, I'm selling Acme stock at $100 and no one is buying. There are no buyers. I'm the only one selling. No one else is selling. I'm the only one selling, and I want to sell it for $100 and nobody's buying it. It means it's not worth $100. Well, do I want to drop my price to 90? Nope. I'm staying at 100. 100 or bust. Well, that means the price is still 100 because no one's buying it. It should be 50. If somebody were to put in a bid, they say, I'll buy it for 50. I say, no, I'm not selling to you for 50. I'm only selling for 100. All right, well, I'm not buying it. Let me know when you want to sell it for 50. Well, if you look at the last price that was sold on the stock market, it reflects the last price, right? And this doesn't apply to big, Johnson & Johnson, Apple, Microsoft. It doesn't apply to those because they're traded like every half a second. There's a trade going through. But for some stocks that are illiquid, there might not be a trade in a day. So what's the price? Well, the price is the last reflected trade price. So for existing home prices, if nobody's selling, then the last price is where it was. So you still have some people buying at a certain level. But, if you got a $4 million home or $3 million or whatever it is in that high range, people aren't buying them, which means that they're still elevated in their price, even though they should be a lot lower. So what we're seeing is the new home prices are more reflective of the actual price because the spread might typically be somewhere in the neighborhood of, it looks like maybe 40%, but somewhere between 20 and 40% spread difference between new and used home prices. I shouldn't say used, but existing home prices. So 20 to 40% spread in the difference. But now it's equal, which means that the new home prices are still 20 to 40% above, which means that the existing home prices should be 20 to 40% lower, which means that instead of 400,000, they should be right around, let's call it 320,000. Just do the math in my head. 330, I think is what it is. So somewhere around 330,000, right? Well, that's a lot lower. It says 400, but it's not reflecting in the price. So if you're wondering why home prices aren't dropping, this is why. It's because they're not hitting the market and people aren't buying them. So I'd rather buy a new home price, which is similar and better, and I don't want to buy that old home and no one's selling. So I thought this chart was brilliant in doing that. It lays it out. Certainly, this is my thesis of why, but I think it's pretty obvious. It's dollars and cents. If you can't afford a home, you can't afford a home. So, Doug, you want to comment before we move on?
Yeah, just really quickly. I mean, here's what you can find. I mean, when you're in the normal economy for real estate, you'll find there's going to be pockets where existing resale houses will outsell new. I mean, they're going to be like in Dallas area, inside the belt. You get in the Highland Park area, there's going to be those coveted neighborhoods that people want to get in. That there's just a feeling, belief, desire to be in those neighborhoods. And they're going to continue to typically appreciate and stay strong, even above new builds. But the majority of people they want what Kirk said. They want to have a home that they can be in for, without repairs the next 20 years. And you've seen just, again, over the last 20 to 30 years, especially, but even before that, all these neighborhoods at one time started as new builds. Even some of these, areas like Highland Park were originally new builds. And people will continue to move out and spread out into the suburbs. A lot of cheaper land. You can generally get a better home, more home for the money. But times have changed right now. And now we're starting to see that, there's this talk that real estate is, not going to be under pressure because there's a demand. We need more homes. I will say this, and we could talk about this for another talk. Some interesting stuff coming out of Canada. Canada has just announced the need to build something like 3.2 million new homes. It's going to be very interesting to watch what's going on with Canada and how that might reflect some things that can happen in our own real estate situation here, because they're dealing with the same pressures that we are, the lack of affordability for people to get into homes now and what that means. But right now, again, with interest rates as high as they are, the builders are out there still building new homes, but nobody's if the people that would typically buy those new homes, which a lot of cases are going to be starters or people moving up, can't afford to move into them or buy them, then those prices, and you can see on the chart, are going to keep coming down.
Yeah, totally agree. All right, let's hit another one here. So this chart I like. Haven't seen it in a while. People are talking about it again. So there's been a lot of talk, and especially in the last few weeks, there's a lot more talk. But if you look back, like, I don't know, a year ago or whatever it was, there's this talk about the inverted yield curve. We talked about it a little bit last week. The inverted yield curve is effectively where the short end of the curve, meaning like the 1 to, let's say, 3-month period, has a higher rate than like the 10-year rate. So if you got like a U.S. Treasury that is a 3-month maturity, so you're buying a 3-month. Actually, let's look at CDs. Everyone knows CDs. You're buying a 3-month CD. You can buy a 3-month CD at 5%, or you can buy a 10-year CD, but you can buy a 10-year CD at 4%. Well, why would I buy a 10-year CD if I can get a 3-month CD for 5%? Well, that's what we call an inverted yield curve. Typically, the yield curve works where a 3-month you might be paid 5, then you got the 2-year might be paid like 5.5, and you got like the 5 or 10 years paying like 6, right? So as you go out in the curve, typically the yields go higher, and that accounts for the fact there's more risk in the fact you're holding it long term. That is a normal yield curve. We have not had that in a while. I think for like the last 18 months or somewhere thereabouts, it's been inverted. And what that means is that the 3-month, in this case, the 3-month Treasury is actually higher than the 10-year Treasury. And I'll have to go look up the numbers, but this is showing the difference. So this is showing that as of, what was it, a year and a half ago, it went negative. So as of about a month ago, it was 1.5% difference. So if you had a 3-month Treasury, you could have got it at 5.5%, and if you bought a 10-year Treasury, you could have bought it at 4. Somewhere there, approximately, that's where it was. So that would be the difference, right? Huge difference. And this, if you're looking at the chart, this chart is showing you over the past 40 years, 40 some odd years, of the difference of the yield curve spread. Now, if you look, when did it go negative? It went negative in the late 80s, early 90s, in the 1990 recession. It went negative in the 2000 with the dot-com bust. It went negative in the global financial crisis. I can't tell the year, but it looks like somewhere around '07, I think '06, '07, it went negative. 2020, it went negative. And oh, by the way, today. And if you look at the severity of it, the biggest severity was the dot-com bust, which was like 75 basis points spread. Ours went to 1.5%, double that. It is a huge difference in the spread. Now, I've heard a lot about the fact that when it's inverted, the data suggests that 100% of the time it will lead to a recession. What they don't talk about is the severity. So I'm actually curious if a more severe negative or inverted yield curve, the more severe it is, maybe that's the more severe the recession is. I don't know. There's no data on that. Nobody's studied that or at least published it. They may have studied it, but they haven't published it. So I haven't seen that. That would be a very curious data point for me. So if someone sees that, please send it to us because I'd love to share it in the show. But that being said, when I look at this and I say, all right, what's the one thing we know about the inverted yield curve, or at least the thesis? Well, first of all, it's a thesis, it's not a fact. It's a correlation, not a causation. We talked about last week how there could be some causative effects, but those causative effects don't apply anymore because, decades ago when the financial system was about actually lending, not trading, that actually had an effect and it made sense. Nowadays, it's not about lending, it's about trading, it's about other things, creating, bank fees or whatever they're charging now. So it's a little bit of a different economy. So you can't necessarily say it's one-to-one like it used to be. So I could see how this could happen and not turn into a recession, to be frank. But what I would suggest is this: understand about the inverted yield curve. This is the data suggests that 18 to 24 months is when you see the recession. So this was right around now is 18 months, and 24 months is what, April? So you're really looking at sometime before April, we could have a recession if the data still holds true. And it may not. We may have a soft landing. Jay Powell might be a genius. The government may be really smart. Who the hell knows? I'm guessing no, but that's anything's possible, right? I think the probability is low that we'll have a soft landing, but anything's possible, especially when you manipulate the government data. So if you look at the inverted yield curve, I just wanted to point out the severity of it because it's interesting. But I will point out the one thing that I've noticed in the past when I looked at this was it's not that it inverts. It's that it inverts and comes back quickly. And I believe it's 18 to 24 months after it comes back to a normal yield curve. So it could be that this is pushed out because it's still inverted, or it could be that one of the next charts we're going to show, the amount of liquidity is really screwing up the system. So I want to point out this chart and I'm going to hand it back to Doug. So there's this one chart here which points out the liquidity in the system, which is really important. Here it is. See if I can. Okay, I'm going to have to share this. Okay, so this is showing household excess liquidity. Now, if you look here, the household excess liquidity is typically in line with inflation, or household liquid holdings are typically in line with inflation. It's not a one-to-one correlation, but it's really close to that. Now, if you look at 2020, what happened in 2020? Well, we all remember COVID, right? COVID happened. And everyone got their Trump bucks and everyone got their PPP money and everyone's spending money like drunken sailors. Well, inflation kept going up, actually increased, kept going up, but yet household liquidity started to tail off around 22. And it's still tailing off, not severely, but it's tailing off or at least flatlining. At some point, and the estimation, according to this chart, is somewhere around May of 24 is when the excess liquidity of the household runs out. Now, what does that mean? Well, it's a data point. It doesn't mean anything, right? But if I had to draw a conclusion from what they're trying to say here, what they're trying to say is, and this point I do agree with in part, is that there is excess liquidity in the system, which is skewing all of the economic data. So if you're worried about the recession, where's the recession? Well, there's no recession because everyone's got extra cash in their bank account and they're still spending like drunken sailors. Even though inflation is going up, so many people are still buying their iPhones and their Apple computers and they're buying their G wagons and all the stuff they're buying. They're doing all the rich people stuff because they got this extra cash. And at some point, they're going to run out of cash. But they're still spending like they got it, like it's going out of style, because we've had this problem for like decades that, hey, we just have more cash. We'll just print more of it. But the fact is that's not happening. The Fed is destroying money, not printing it, and interest rates are up, not down, which are factors which shrink the economy, not expand it. So at some point in time, that household liquidity is going to shrink. So instead of having 50K in your bank account, now you got $50, and now you can't go buy that expensive thing because you don't have enough cash because your Trump bucks ran out. So if you think about inflation, we started talking about in the show a few weeks ago how anecdotal data is starting to come out, and I mentioned it's anecdotal because it's not scientific, it's anecdotal, and it always starts with anecdotal, right? And the best people like Peter Lynch always used to talk about the anecdotal data he got. He would go into the store and say, all right, what are people buying? Oh, people are buying legs that when that came out, or Spanx or whatever it was. I forget the woman's name who did it. Brilliant entrepreneur. She started Spanx, and it was just like she saw a need and she filled it. Well, if you start seeing the store, people are buying this or buying Lululemon. This is a big thing when people were buying Lululemon or Crocs. It was like, well, how do you know to buy Crocs? Well, like, well, my kids want them. Okay, great. So that's what that was Peter Lynch's thesis is. Let's see the marketplace, see what people are saying, and I think that holds true with everything. So what I always start with is anecdotal data. What are people saying? What are people thinking? How are they feeling? And right now, people are starting to feel the pinch. There are people who can't afford to drive their car to work because they can't afford to fill their car with gas. That's how close they are with their finances. So what do? We go on unemployment, and so there are a lot of people where this is getting really tight. Now, there are people listening to the show, this might apply to you, and there are people listening to the show, you're like, this doesn't make any sense, I've got plenty of money. It's not about you, right? It's about 350 million people aggregated together. What is the aggregate? Because if 1% is feeling okay and 99% aren't, then you're going to have a French Revolution, right? So you got to cater to everybody, and you have to appeal to the fact that there are people hurting in this economy, and the more they hurt, the more crime, the more struggle, the more pushback they're going to have for everybody else. There's a reason why these one percenters, these CEOs, have bodyguards. They know. They're not stupid. They read history. They know how it works. So just understand that if household liquidity runs out in mid next year, that could be a big pinch that we're not really predicting right now. It could be that things change by then. I don't know, but it's a factor in the equation that when you run out of money to spend for things, you don't spend for things, which means you spend less. You start to seeing this in earnings. We talked about this last week, how different corporations are starting to blame theft for their earnings. Imagine that. So they're throwing out everything with everything in the kitchen sink with the bad earnings. That's going to probably happen. I don't know if it'll be this quarter or next, but you're going to start to see it. So just be aware that this is one of those charts where it's just kind of like a, that's interesting moment. It's not a sell everything and stick it under the mattress moment, but it's a, that's interesting moment. Doug?
Well, yeah, I like what you said. I mean, first of all, take that image that we were looking at before and invert it, and it looks just like rotate it a little bit. Oh, it looks exactly like the SPAC chart. So, again, interesting correlation to lots of money in the system, and you can see in that chart, the money is still there. It's just dwindling. But guess what? As you mentioned, the 1% has the majority of that money. The 99% does not. And we're starting to see some adjustment for that happening in a number of different places. And again, you go back to the ones that did get it. I mean, there's a lot of variables for this, but a lot of people have talked about where did the workers go, and there's a lot of things that came in with that money, where that money allowed people to start making some different, personal financial decisions. Although we're going to find out in time whether or not those personal financial decisions were something that was going to be a systematic, secular change, or just a cyclical change based off of what was a temporary influx of that M2 money that's now coming back down to earth. And you can see great chart here. If you take a look at the real personal income, clearly you take a look at the real personal income that people have, and the real personal income excluding current transfer receipts, which is moving money from one place to the other. It is certainly, it dipped, it spiked, it's flattened out, but it's way below where the trend, although that still stayed flat, look at the blue line in comparison to the green line, which is the personal income. Yeah, has it been going up? Sure. But the real disposable income has plummeted against that, leading to a very big discrepancy. between what people are taking in and what they actually have available. And we've talked about before what's going to happen now that certain things like student loan debt forgiveness, or not forgiveness, but student loan debt deferment is going to come back in and put another squeeze on income. The other thing that I wanted to talk about is you talked about the 1% versus 99%, the whole French Revolution thing. Listen, we're starting to see some signs of this already. And it's not just a revolutionary aspect, but a keeping in mind that where that wealth is created, it is on the backs of people that have to work to create that wealth. And now, granted, there has been automation and other things to be able to create and work, generate that. But we just have, here's a great sign that just happened. It was UPS workers went on strike, and they were able to get a historically good deal with UPS that probably staved off an incredibly disastrous economic impact of UPS shutting down for an extended period of time. But guess what just happened, Kirk? The United Auto Workers Union went on strike against General Motors, Ford, and Stellantis. Now, Stellantis is the new name of Chrysler, Fiat. So this is still the big three, right? It is the first time in history that a strike has struck all three of the nation's unionized auto workers at the same time. It began on last Friday, it began today, September 15th. And they're looking to try to get concessions that lost over 15 years ago. It's looking to protect against, during the transition from electric vehicles. Listen, I don't know about you, but anybody looked at auto prices recently? Has anybody looked at auto lending recently and what it costs now to get a new vehicle on a monthly basis? We had problems getting cars because there was a supply chain interruption. Then we had problems getting cars because there was still a chip interruption. Then we had trouble getting cars or paying for cars because as that came back, we still had a supply-demand bullwhip disequilibrium that was occurring based off on lots of money out there against limited supply. Guess what? The auto manufacturers, if this goes on an extended strike, what does that do to the supply of autos? Even worse, right? So this is good. These will have these kinds of situations and disruptions can lead to an exponentially increased correlation of inflation on the goods and unavailability of the goods and services we're looking for. That does, Kirk, disrupt the 1%, right? That disrupts the wealth. That disrupts the ability to create. So we are all impacted by what's going on here, okay? And I think that's something to be very aware of, that even though you may not be feeling this personally, and a lot of people still are not, a lot of people listening to this podcast may not be, because you just may be a different demographic listening to it. But there's no question the bottom 50% are feeling it, but it's creeping up and squeezing into the bottom 75, 80% that are all complaining, and maybe even more up to that 95 to 99% that are starting to feel the difference. And that leads to different choices. And that, those choices impact real estate transactions. They impact the purchase of goods and services. I was talking to someone just the other day. They own a regional furniture company, and they've done wonderfully well the last couple of years. But guess what? They said this year, tremendous decline in sales. Okay. Starting to see that what was moving very, very quickly, discretionary goods may start to be under more pressure, because we will all have to start making financial decisions with where every dollar goes in our household. And those decisions are starting to be made more and more down at the bottom line. And guess what? The 1% may have the money, but the 99% of people buying have tremendous impact on our economy. Right. So if that stops, just be aware that will trickle up.
Yeah, let me make one more point. We can kind of wrap it up here. And so somebody sent me a video, probably Doug. I can't recall offhand. It's always Doug. Doug always sends me the best stuff. There's a video of a guy who's kind of going through the luxury good market. And, I think over the last few years, what we've started to see is people are taking all that extra spending and they're spending it, right? Just buying Lamborghinis and buying, Rolexes and buying all that stuff because they had extra cash. And, a lot of people were making money through SPACs and crypto and all this other stuff and meme stocks and people had all this money and they're like buying this rich people stuff. And I mentioned this because you tend to see this success in this excess in bubbles. You tend to see this kind of behavior. And now what he was showing, and it's anecdotal because I'm only telling you this because it's anecdotal, because I haven't background checked what this actually is or his evidence. But I thought it was interesting because he was just showing how you couldn't get a Lamborghini for 3 years. You wanted to buy one, you had to wait 3 years to get one. And now people are just dumping them in the market for less than they paid for them. Now, I don't really look in those markets because I don't really care. I don't want a Lamborghini. I'm not a stuff guy, so none of that stuff appeals to me.
I can't afford a Honda, Kirk, but I'm going to go out and get a Lamborghini now because they're on sale.
Yeah, I mean, but think about it though. I mean, this is actually pretty interesting. So when you see markets like this is where they call it like vulture capitalism. This is where people come in and they swoop in and get the deals. Like, look, if I could go, if a Lamborghini goes for 300,000, I could buy it for 100,000. I'd buy that and garage it and store it away for a few years and wait. I mean, why not? It's like buying a house, right? As long as it's in
It's
good
the
shape.
Florida real estate market, in 2010 plus, right? After it's
Right.
coming back from the crash.
Right. I buy the car for 100,000. I store it. Maybe it costs me 10 grand in storage fees over the next 3 years, 5 years, and at some point it's worth 300,000 again. But the point is like there are going to be opportunities in these markets, right? And if you can be prepared with a pile of cash in these markets, you might go buy a Rolex, which is typically $1,000. You might be able to pick, I don't know what the price, but $10,000, and you can pick it up for 500. A real Rolex, not a Rolex, but a Rolex. So, understand that is going on, and that discrepancy at some point gets fixed. But we're just at the beginning. Like, we haven't had a recession yet, according to Brandon. But we haven't had that recession, which some people claim is already a recession. I don't really know or care, but we haven't had a full-fledged recession. I would agree with that. I think those sentiments are correct. Like, we haven't had a recession where everyone's out of a job and hurting, and usually that leads to lower inflation, not higher inflation, except for stagflation, which we still could have. But I think the dynamics are such that it's going to lead to deflation, like we've been talking about. Even though we did have a blip up this month, was the second month in a row, which we had a blip up in the annual inflation rate, but it's still low in comparison. And I think we still could keep going lower. It might bump a little bit, but the oil prices are what's bumping it. So if oil prices keep going up, yeah, it could keep bumping, but it's not like it was before. And I think that's
And watch
really
that
important.
because expensive oil has never been great for the economy.
Right. Well, I do agree with that. I think that expensive oil is going to cause a recession, if nothing else, because it slows everything down. Everything's more expensive. These people can't afford to get to work. Now they definitely can't afford to get to work. Maybe they should take a bicycle, assuming they're close enough. But we're going to have to find ways to accommodate people who can work from home. Will just work from home. But there are plenty of people who have blue collar jobs in this country. They can't work from home. They got to drive to work. They got to build houses. They got to do plumbing. They got to do electricity work. They got to do all the stuff. Like, there's plenty of blue collar people there. Well, apparently not the auto workers, because they're on strike. But once they get back to work, they'll probably be having to drive to work.
They don't have to drive to their job making things that drive. So.
Yeah, I know. How interesting. Actually, I was thinking of something yesterday when I saw the auto worker strike, and it was like, we're going to strike. I'm like, it's interesting. Here's what I wonder. And hold on.
Get the hat.
I got the hat. I got to put the hat on before I wonder. So here's what I wonder. Anytime you see a strike nowadays, right? I know there's negotiation that happens in striking and all that, and they don't get paid and they don't pump out cars. Here's what it makes me wonder. Is it to the advantage of the executives of the auto company to allow them to strike? Because now they have an excuse for poor earnings. Now, I'm not saying they do this, but if I was an executive and I was trying to hide bad earnings, what a great way to hide bad earnings than, hey, do you guys want to strike today? How about you strike? We got a contract. Why don't you just strike so I can shove all that bad data into the strike? Oh, well, we didn't have people working. We couldn't pump out cars. I'm so sorry. Oh, poor this. I'm not saying this happens, but we live in a society where this kind of stuff does happen, where it's not like the old days where we weren't connected. And so I'm just saying this because you've got all this I don't want to call them deep fakes. That's the wrong word. But you've got all this kind of false flag kind of information, like, oh, this stuff's happening, and oh, it's all we all blame it on this. It's all blamed on currency. It's all blamed on this. It's usually a farce. It's usually something else, but they can't blame it on themselves because it's not my fault that business is faltering. It's somebody else's fault. Boo hoo. I'm not a leader. I'm just a follower. I'm just telling you what you want to hear. Unfortunately, that's the corporate America we live in. There are leaders, but they're few and far between. So the people are willing to stand up and say, yep, sorry, we missed the ball this quarter. Our fault. We'll get it next quarter.
Can I add something? Because a
Yeah,
week ago, I believe that weren't you talking about how oh, hello. I just lost my background on
That's
it.
okay,
Well, hey,
Doug. We love you anyway.
welcome to the white wall. Anyway, a week ago, you were talking about how sometimes you'll start to see, and again, keeping that tinfoil hat on, you'll start to see when the bad news comes out, they'll all pile the bad news out at the same time from all the companies because it's good to have one bad quarter together. And so you're not the outlier. Maybe the auto workers strike again, tinfoil going on. Good timing for that. Right around the time when we're supposed to start seeing some really bad numbers.
Yep. Anyway, we're gonna let Doug wrap it up because we're at the hour here and we gotta go. We got a thing, as Fletch used to say. I gotta go. I got a thing. So Doug, where can people find more about you?
You can find more about me at procollegeplanners.com. So again, we're talking about inflation. Talk about costs. We're talking about the pinching of the budget. We're talking about the impact of student loans hitting people back on their off of this enhanced deferment. Listen, don't be one of those people. Whether you're trying to just figure out what school is going to be the best school for your kid, get the scholarships, get the tuition discounts, or just have a financial plan to pay for college and protect your hard-earned assets and income, get the information and knowledge you need to be able to be smart and make smart financial decisions about your money, especially when it comes to college. Go to procollegeplanners.com. Actually, for some reason, that link isn't working. Try procollegeplan.com. We're doing some things to the website, and so not everything's functioning. Procollegeplan.com will take you to the website right now, so go there first.
Well, if the website is not functioning, Doug is. So you can always, where to reach him. You can always
reach out. Just email me at Douglas at procollegeplan, at Douglas at mergentgroup.net. It's a good way to reach me.
Awesome. Well, that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. So please send an email and express your feelings. Just make sure you don't get on an airplane shortly thereafter. If you're seeking financial advice, talk to an oracle or a fortune teller or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.